This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, back in our first lecture on groups, we made the point that probably the biggest issue and the most examinable subject within this area of groups is that of group relief of losses. Now, we'll go into the detail of that in a few moments' time, but I hope you have gone back since our first session and looked at the example that I gave you in terms of who was able to group relieve with whom within what we referred to as a 75% group. If you haven't already done that, I'd ask you before going any further to go back and look at that so that we'll be able to make much more sense and deal more happily, I trust, with this particular subject area, as it is a critical one and probably technically the most difficult that we have to deal with. Now, in our introduction here, we will remind ourselves that the relief allows companies in a 75% group. More detail on that when we get to indirect subs and sub-subsidiaries in a few minutes' time. But you have to be in a 75% group to then transfer any part of what we'll say just at the moment, and it's always the big one, the main one, any current year trading loss of one such group company to set off against any part of another company's within the 75% group taxable total profit, it's TTP, of a corresponding accounting period. Now, you wouldn't expect in practice this last point to be an issue. You'd expect all companies, especially within a 75% group where you've got absolute ownership effectively there in terms of control of the subsidiary companies, you wouldn't expect to see companies within the group preparing accounts to a different date. But for exam purposes, there's always a distinct possibility that you might have two companies looking to group relieve with one another in the same 75%, one company preparing up its accounts to one date and a different accounting period end date being used in the other. And therefore, we've got to match corresponding period to corresponding period. The loss-making period of the loss maker will span two accounting periods of the profit maker. So an apportionment exercise needs to be done. It's just a more difficult mechanical exercise. The theory is simple enough, but don't worry, we'll see that later in this particular series of lectures. So the big thing there was 75% group, and I've said it's about relieving, to begin with at least, a current year trading loss. Now, group relief is not confined to just trading losses, but we make the point here that we could transfer any part of a current year trading loss. So if within a group company, within a 75% group, you have got trading loss of £100,000 and you've got, say, property income of £20,000, then this is telling you that if you want to, you do not have to use any of that trading loss made this period of £100,000 against its other total profits, which would be its total profits here, its property income of £20,000. Remember, on a corporate tax computation, if you've got a trading loss, the assessment would be nil. If the only other profits chargeable this period was the property income, then it would have total profits of £20,000. One obvious possible relief is a current period claim against those total profits of 20. But you don't have to do that. And instead, if you wanted to, you could take any or all of that £100,000 of trading loss made by the loss maker and surrender it to one or more companies within the 75% group and put against the taxable total profits of that claimant or those claimant companies there. So we've got a lot of flexibility. With flexibility comes choice, and with choice that means we've got to exercise planning skills to decide, well, I could do this, I could do that. Why would I want to choose one particular route over another? What are the objectives that we strive to achieve when applying any loss reliefs? That, of course, is something that you should know anyway from Chapter 18. So again, if you haven't looked at them recently, go back and remind yourself of those single company trading loss reliefs. The current period claim, as we've mentioned there, the carry back and the carry forward claims. Because again, if you have a company like this one within a group, you don't just look at group relief. You have the options of what could that company do with its own loss? Well, as we've just said, sorry about that, I hope you got the screen back. What could that company do with its loss? Current period, if it made a current period claim, then it could carry back 12 months, which you'd usually be against. You'd expect the previous accounting year ends profits. Notwithstanding that, if you didn't make that claim or you made neither claim, but any loss left over after current and carry back claims have been considered would then be carried forward, and all of these claims going against total profits. With the current and carry back claims, there was no flexibility. If you made the claim, the loss would go against all of those total profits. You either made the claim or you didn't. But when you go forward, you have, as we will also have here in group relief, flexibility. You could use some or all of that loss on a carry forward against the total profits of a future accounting period. You had choice flexibility over how much loss to put against future profits. But if you want to use, as you probably would want to use, those losses sooner rather than later, again, we like to get the cash flow benefit of using a loss at the earliest available opportunity. So if we're able to use it now, as we are with group relief, then again, you've got the flexibility. You can put any part of that loss against any part of, and it's not the total profits, it's the taxable total profit. It's that bottom line TTP that is being targeted in terms of the claimant company's profits with any amount of the surrendering company's loss there. Now there, any amount of that loss could be used. But group relief is also available in respect of. Now here's an important word coming in each of these two cases, though these are far, far less likely to be tested in any such exam question. But the word excess. Excess qualifying charitable donations and excess property business losses. What you know is, firstly, with qualifying charitable donations, they were deducted from total profits to give you the taxable total profit. So if we had a total profit, let me just quickly put this in, a total profit of £10,000, but we had qualifying charitable donations of £15,000, then on the corporate tax computation, the TTP would be nil. It wouldn't be -5. You have got there excess qualifying charitable donations of £5,000. So you must use those donations first of all against the total profits of the period. And only then if those donations, qualifying charitable donations, I should say, if they exceed the total profits, do you have an excess amount of qualifying charitable donation? And in this example here, that would be £5,000 of excess qualifying charitable donation. So if it was a trading loss, you could take all of the 100,000, any part of it. But with either qualifying charitable donations or with property business losses, it's only excess amounts. What excess means is, after having deducted those amounts of donation or property business loss, firstly from the total profits. So group relief only then becomes available if those donations, if those property business losses have exceeded those total profits of this period. Then the excess is eligible to group relief to be surrendered to your other 75% group companies. As we say here, such losses are only excess if they exceed the total profits of the company concerned before any other losses have been applied there. As stated in Chapter 18, we reminded ourselves of that a moment ago, any unused trading losses or property business losses brought forward by a company may now also be surrendered as group relief. So we were focused up here on talking about current year trading losses. And until just a few years ago, that was the only loss that could be group relieved. But now, with the changes and the rules as we have them now, will allow for unused trading losses or property business losses brought forward by a company may now also be surrendered as group relief, but only to the extent that the loss-making company is unable to set that loss against its own total profits. So if we have a company that has such a loss brought forward, then we must firstly apply any such brought forward loss against the total profits of this company's current accounting period. Only then, if those losses were unused, could that be surrendered in the form of group relief. Any unused trading losses or property business losses brought forward by a company may now also be surrendered as group relief, but only to the extent that the loss-making company is unable to set off the loss against its own total profits. If the company with those brought forward losses has sufficient total profits this period to absorb those brought forward losses, then whether you claim it or not, you will be deemed to have used those losses for purposes of knowing, can I group relieve that brought forward loss? And no, you won't then be able to group relieve that brought forward loss if the total profits this period of this company that has the brought forward losses, if those profits are big enough to absorb those brought forward losses. That is where they would be deemed to have been used first, and if that total profit exceeds that brought forward amount of losses, then no group relief would be available. The company with the loss brought forward would not be allowed to surrender any of those losses brought forward. Now, the chances are, of course, in reality, is you'd use them anyway within that company. You don't want to keep on carrying forward losses. If they could be used this period, it wouldn't make any sense really to do so. Okay, so our normal situation, therefore, that we find is a very simple group structure. We have a definition of a 75% group. One company is the 75% subsidiary of another, or both companies are 75% subsidiaries of a third company. And then if any one of them were to have made a loss, it could group relieve against any part of the taxable total profits of any other company. So here is a simple example where we have a holding company owning 90% of the shares in each of its two subsidiary companies, S1 and S2. Now, the number 90% of itself does not matter. The significance of 90 is that it is at least 75%. So I could have put in here any number that was a shareholding of 75% or more, and the outcomes would be the same. If any one of those companies were to make a loss, for example, their S1 were to make a loss, definition of a 75% company, one company is the 75% subsidiary of another. So, yes, S1 is the 75% plus subsidiary of H, and therefore it can group relieve with its holding company. Both companies are 75% subs of a third company. Yes, S2 here is also a 75% plus subsidiary. These two are both subsidiaries of the same parent company. So that loss made by S1 could be relieved in any way you wished within the group, some of it or all of it to the holding company, some of it or all of it to the subsidiary. You could split some of the loss to H, some of the loss to S2. And it doesn't have to be all of the loss, though if it's probably got sufficient profits in those two companies, then you probably want to do that and relieve it now. The amount of loss that can be surrendered to the claimant companies, any amount of a trading loss, or if we're talking property business losses, only if they exceed the total profits of the current period. And if it's qualifying charitable donations that are unused, only excess qualifying charitable donations of this period may be used. Now, the usual determinant of 75% is that we own at least 75% of the share capital. And these were the percentage shareholdings that I just gave you, and we satisfied the 75% rule, no problem. But sometimes you get, and I think they're silly objective testing questions, where they're asking you as to who can group relieve with whom and giving various circumstances of the issues pertaining to the 75% holding. And the holding company here must own at least 75% of the share capital. That's the one that you really must know. And be entitled to at least 75% of the sub's assets on winding up, and be entitled to at least 75% of the sub's profits on a distribution. Now, again, in any practical example with numbers, it's going to be, here's the shareholdings, and that's it. And either you do satisfy the 75% shareholding or you don't. Simple as that. But again, a narrative, rule-based objective testing question could be testing you out on, do you know those two other provisions as well? Nothing to worry about at this point in time. Another one of those silly rules that are not important to learn now, but if you have time before the exam, once you've conquered everything else, well, you just come back and think, yeah, those are also rules that need to be satisfied for group relief to apply. So where it's just a simple group structure, parent company and direct subsidiaries, it's very obvious whether you've got the 75% interest, allowing then any one of them to group relieve in part or in full its available losses against any part of the claimant company's TTP. Life gets more interesting where we have indirect or sub-subsidiaries here. So then the holding company must have an effective interest in any sub-subsidiary of at least 75% for them to be in the same group for group relief purposes. For example, if a parent company owns 90% of the shares in a subsidiary, well, there's the holding company, the parent company, owning 90% of S1. And S1, in turn, owns 90% of its subsidiary. It owns 90% of S2. Then all three companies would be able to group relieve with one another, as the parent company has an effective 81% interest. 90% of 90%, 90% times 90% there equals 81. That means the effective link from H down to S2 is an effective 75% plus holding, and therefore any of those three companies can group relieve with one another. If you had the situation here where instead of S1 owning 90%, as we had it there a moment ago of S2, it was, say, 80%. If that were it, if the subsidiary owned only 80% of the shares in the subsidiary, as we have it now, then the parent company may only group relieve with its direct subsidiary, S1. H cannot group relieve with S2 because the link to the sub-subsidiary, the indirect sub, the effective 90% of 80% is only 72%. That was the effective holding. So the parent company could only relieve with its own direct subsidiary, S1. The sub-subsidiary, S2 here, may only group relieve with the subsidiary company. It can only group relieve with S1. But the subsidiary company, in my example there, S1, is in a group relief group with both its parent company. H owns 90% of it, S1. They are in the same 75% group. And its own subsidiary company, S1, owns 75% of S2. and is therefore able to group relieve with either its parent company or its own subsidiary. So we've got to be careful here. If you've got just 100% shareholdings, you don't have a problem when it comes to indirect subs. Of course, you have effective 75%, and therefore any of them can group relieve with any other. But we've got to look at it very, very carefully in terms of where there are minority interests being held by parent companies. Sorry, there is a minority interest, so the parent company doesn't wholly own, doesn't have 100%. There are other shareholders. We need to check that out to find out, as here, who is able to group relieve with whom. And there may be different group structures within the overall group. Here, making it 80% that S1 owned in S2 doesn't change the fact that there are 3 companies in that group. But for taxation purposes, looking very specifically at one issue, group relief, for group relief purposes, we've got different companies being able to group relieve with one another. It's not the same for everyone. S1 was the lucky one in the middle. It was in a 75% group with both its parent and its subsidiary. So if it made a loss, it could surrender that loss to either H, its parent company, the holding company, or S2, its subsidiary. If either S2 or the holding company had made a loss, it could be a claimant company and take that group relief from that other company. But H could only group relieve with S1, S2 could only group relieve with S1, H and S2 could not group relieve with one another. So when you've got, again, indirect subs, if it's not given in diagram form within the question, which it may be, but it's just in narrative form, then quickly in your notes, draw a little picture, as we've done there, about what that group structure is, to be able to identify who is able to group relieve with whom. You then got there example 2, where, again, a bit of a nonsense in terms of real life here, unless you're trying to launder money and you want a complicated group structure. But what we've got is, starting with Z PLC, ownership in a sub-subsidiary, and we go a step again down to C Limited. And what we want to know is, for the year ended 30th of June 21, if Z PLC has a trading loss, who is it able to group relieve with? Remember, you need to have effective 75% interest. That shouldn't take you very long. Hopefully you've already done it. Anyway, there, the maths is not tricky. But have a think through, make your mind up, look at the answer, and I'll quickly look at that with you in a moment's time. Okay, let's see what you've got. Hopefully you've read through the answer there so you know what's coming. But again, what do we have? Z PLC owned 100% of A Limited. Clearly those two can group relieve together. We had to state the companies to which Z PLC may surrender its trading loss in the year ended 30th of June 21. So clearly it can surrender that loss to A Limited. Then the indirect sub, well, no problem there. 100% times 80%, 100%, 80%, down to B Limited. Well, that equals 80%. So yes, Z PLC can group relieve with both A Limited and indeed B Limited, both there and there. Indeed there, if A Limited or B Limited made a loss, they too could group relieve with one another, or indeed with the parent company Z PLC. But of course, as soon as we come down to C Limited, we've got that effective interest down to B, 80% times 80%, and that equals 64%. Therefore, Z PLC is not in an effective 75% group with C Limited, therefore cannot group relieve its loss against any profits there of C Limited. In terms of can C Limited group relieve with anybody? Well, yes. C Limited is the 80% subsidiary of B Limited there. So those two can group relieve. What about A Limited? Well, no. When you look at the link from A Limited down to C Limited, again you've got the 80% of 80%. There's 80, there's 80, equaling 64%. And that means that no, C Limited is not able to group relieve with any other company within the Z PLC group other than its own immediate 80% parent, B Limited. So we could define there are different groups for purposes of group relief within your group structure. Okay, in that first lecture that we had together, I gave you the AV group of companies there with, I think, those percentage shareholdings. If you can find it, fine, go back to that. Hopefully you remember looking at that quite recently and revising what we said about who could group relieve with whom. But in this, we've got company F here making a loss, and all the other companies, the principal parent company, AV, with a profit, its co-subsidiary, C, making a profit, its own subsidiary, Clarence, with also a TTP, and the subsidiary of C, Blues, also with a profit. And what I'd like you to do there is to identify where that loss of F may be group relieved, indeed who may group relieve with whom. Could you sort that out for me now, please? Okay, so within the AV group of companies, therefore, who is able to group relieve with whom? Well, we've seen this before, but let's make sure we've got it right on this occasion. Now, AV owns 100% of F and 80% of C. Clearly, those direct subsidiaries have an effective 75% control by AV, and therefore, if any one of AV or F or C were to make a loss, it could group relieve that loss against the taxable total profits of any of those other group members. Life gets more interesting when we drop down a further level to indirect subsidiaries. Where it's indirect, again you need that effective 75%. Now that's okay when we look from AV down to Clarence. 100% of 90% there will of course equal effective 90%. And that means that within the same group, you have AV, F, C, and Clarence. But what about Blues there? Now, as soon as you see that figure, the share ownership by the subsidiary of AV, company C, in its own subsidiary Blues is only 70%. And that therefore means that you don't have a 75% group relationship, and therefore no group relief is available. So with the context here of F has sustained a loss, any part of that loss could go against any part of the claimant company's profits, and those claimant companies could be AV, the parent company, Clarence, F's own subsidiary company, and its co-subsidiary of AV, company C there. And if you wanted to put all of that loss against, if there were sufficient taxable total profits that is of any individual claimant company, you could do so. But if you wanted to use some of the loss against parts of the profits of each of those three companies, or two, or just one, it's entirely up to you. And you don't have to use all of that loss. Here you have a free choice within the AV group to take any part of that. Again, the principal loss concerned is always going to be a trading loss, of course, there. That trading loss and relief against the profits of AV, against C, and against Clarence. But no group relief would be possible in terms of that company Blues, not because just that 80% of 70% would equal 56%. You knew that the effective was going to be less than 75%. As soon as you saw the direct interest at being 70% there. But what about if the shareholding by company C in Blues, if that had been 80%? What then would have happened? Well, again, could company F here group relieve any of that loss against now Blues' TTP? Well, the answer would be no. Even though this is 80%, 80% of 80% will now, of course, equal an effective 64% interest. An effective 64 is not, of course, sufficient. It has to be effective 75. So Any amount of loss made by company F here would not be group relievable against Blues' profit. Why? Because the effective is less than 75%. However, you would have then a slightly more interesting group structure as regards who may group relieve with whom. You would have here the basic group relieving group that would still be AV, F, C, and Clarets. And if any one of those were to make a loss, it could group relieve with any other. But we also now have a further group for purposes of group relief. Company C, as we can see here, has 80% of Blues. So those two, C and Blues, are themselves within their own 75% group. What it means is that Company C, if it had a loss, could effectively group relieve against the profits of any of those other companies. C is in a group with AV, with F, and with Clarets, and also in its own subgroup with Blues. So it would be able to share its loss amongst any of those other four companies. Blues, on the other hand, down here, is only in a 75% group with its own parent company C. So Blues can only group relieve with company C. So what you may get for purposes of group relief, when you have indirect subsidiaries and you have less than the 75% ownership on an effective basis from a principal parent company down to a sub-subsidiary, then you may get the situation where there is more than one group for purposes of group relief. So in attacking any problem, you need to understand what those group relationships are. If we're talking about group relief of losses, identify. There's always going to be the main group, which will stem from the parent company, principal parent company, here AV. It will extend to its direct subsidiaries, here F and C, as long as they are at least 75%. It will extend to indirect as long as the effective percentage is 75%. If the indirect is less than 75, then you can't, therefore, have the principal parent, AV, group relieving with the sub-subsidiary, the indirect sub. But if, of course, as we have seen, that the relationship between the subsidiary of the principal parent company and the sub-subsidiary, if that is at least 75%, then these guys here, those two can themselves separately group relieve. Okay, going back to our notes, therefore, and just put together stuff that we already know now, we've seen that now it's not just trading losses that are eligible for group relief, and we'll remind ourselves of the other lesser possibilities, but still possibilities in a moment's time. Trading loss is the big one, may be surrendered to other companies in the group, which may then relieve the losses against their own TTP. So any amount of trading loss of the loss maker may be surrendered and relieved against any amount of the claimant company's TTP. Any member company may surrender its loss to any other member of the group, so we can go in any direction. A holding company could surrender its own loss to a subsidiary. A subsidiary could surrender its own loss to the holding company. Or, of course, a subsidiary may surrender its loss to a fellow subsidiary company. Just as we've seen in the AV group of companies, all of those possibilities would exist there. The names there, the surrendering company, of course, is the one that's made the loss, and the claimant company is the company to which the loss is surrendered, the one that has the profits available to be relieved. And let's just look in a bit more detail, therefore, at the losses of the surrendering company that may be group relieved, and then the profits of the claimant company against which such losses may be group relieved. So the surrendering company, the loss maker. The surrendering company may surrender as much of its trading loss as it wants to. Remember, it is not necessary to relieve a trading loss of the loss maker against its own income and gains first. where you have this group member within the 75% group, if it makes a trading loss, then you can relieve against your own total profits. And if you've done that, you can carry back. And if you've done that and there's still loss left over, it can be carried forward. But instead, if you so wish, any or all of that trading loss is available to be group relieved. Any or all of it is available to be group relieved. The losses, as we say, which may be surrendered are, and here's the first one, any amount of a current period trading loss. So if we just go back to our notes here, here you've got an example of a loss maker, the surrendering company. It is sustained, as we've agreed, is the most likely loss for you to see, but not the only possibility. A trading loss there of £100,000. It has property income of £20,000, and it's got qualifying charitable donations paid in this accounting period of £5,000. So what have we got? On its corporation tax computation, what would we have? We don't have bracketed figures. Where there's a trading loss, the assessment is nil. We have property income 20. We have a qualifying charitable donation of 5. So at the moment, before anything else is done, on its corporation tax computation, even though it's made a loss of £100,000, it is still showing a TTP, total profits, taxable total profits there of £15,000. So if the group so wishes, any or all of that £100,000 could be surrendered and used within the other 75% group companies. It, the loss maker, doesn't have to use any of its own loss against its own profits. If you want to do that, then that would be a separate claim. But in group relief terms here, any or all. So if a question asks you here, what is the maximum loss available to be surrendered by this loss-making company? We're looking at it there. It is this £100,000. There is no requirement prior to a group relief claim to use any part of that company's loss against its own profits. Remember, of course, if you did make a current period claim, it goes against total profits, not taxable total profits. And that here, there would be your total profits. I'll repeat, this figure here is your taxable total profit. So any part of that 100,000 loss, if you wanted to make a current period claim, that would be the amount of the claim. But of course, in so doing, it would create there that unused qualifying charitable donations of £5,000. So it's presumably not something you would wish to do. Another point here, remember, you talk about the other losses that are, or other figures that are available for group relief. Let's go back here. We've already seen any amount of a current period trading loss. You could also take, now we use the word unrelieved here. The word we used earlier, and is exactly the same here, is excess. Any unrelieved qualifying charitable donations of the period, any unrelieved or excess property business losses of the period. If I go back to my example here, in terms of the original corporate tax computation that we prepared, we would have had, as we saw, £20,000 of total profits, £5,000 of qualifying charitable donations, deducted from the £20,000 total profit, leaving us with £15,000 of taxable total profit. In this example, there are no excess qualifying charitable donations. As you can see here, on the figures in the corporate tax computation, there is total profit of 20. That is more than sufficient, therefore, to absorb the donations paid of 5, still leaving a figure of taxable total profit of £15,000, which would duly be charged to corporate tax. We also said that if you wanted to, it is unlikely that you would, that we could, of course, offset that company's own loss against its own total profit of £20,000. Remember here, such claims you cannot make partial claims, and that means that in so doing you'd have to use £20,000 of its own loss against its own total profits of 20. That therefore would leave nothing to deduct the £5,000 of donations from. Now you may be thinking, well, that won't matter because then it's excess and that means that we can group relieve. No, you can't. There are no excess qualifying charitable donations here because looking at the corporate tax computation prior to any loss relief, we had 20,000 total profit, 5,000 donations, TTP of 15. There were no excess qualifying charitable donations. You cannot create excess qualifying charitable donations by the use of another loss, i.e. you used 20,000 of the 100,000 loss in a current period claim against that £20,000 of total profit there, and that meant there was nothing then for the donations to be deducted from. They were unused, they were unrelieved. No, you could not then put that into a group relief claim because it had been created by the use of another loss relief. That therefore does not rank for this purpose as excess qualifying charitable donations. So, those losses available to be group relieved, by far the most likely in any exam question is your current period trading loss. You may have unrelieved or excess qualifying charitable donations paid. You may have unrelieved or excess property business losses. Again, all of those of the period. Any of those, any amount of current period trading loss, any excess donations, excess property business losses, i.e. after they've been deducted from total profits, those too would then be eligible for group relief. Subject to what I've just said there, you can't create excess qualifying charitable donations by the use of another loss, like your current period claim here. But all of that has been about current period losses there. What we also have is unrelieved trading and property business losses brought forward can be surrendered as group relief, but only to the extent that they cannot be set off against the surrendering company's own total profits there. So if you have a brought forward loss, be it trading or be it property business losses there, then those would potentially be able to be group relief, to be surrendered now in this period to another one of the 75% group members. But the critical issue here can be surrendered as group relief, but only to the extent that they cannot be set off against the surrendering company's own total profits. So if you want to use any of that brought forward loss in a group relief claim, that would only be possible once you had used firstly that loss against any amounts of this company, this previous loss-making company, the one with the loss brought forward here, against its own total profits of the period. Only then, if excess, could any such excess amount be surrendered as group relief. But the company with the losses brought forward must be deemed to use it against its own total profits first, before then any excess over and above its own current period total profits. That is what could then be separately group relief. That is what you could then surrender. You didn't choose to surrender it for whatever reason when the loss actually arose. It has been brought forward to this period, subject to using it firstly against its own profits, own total profits of the period. Anything above that, yes, now you could choose to separately group relieve that. We, again in our original discussion of what losses were available to be group relieved, mentioned that capital losses are not eligible for group relief, but are dealt with separately under what we call gains group membership. It will effectively mean that yes, we could take a capital loss out of one company for the current period and relieve it against gains made in any other what we'll call gains group members. But this is not group relief. Again, if you can't remember that, go back to that earlier lecture that we did where we made reference to this. But we will be seeing it all later. Gains groups separately dealt with. Group relief, when we use that term, it's those losses that we see noted there. They are the ones, not capital losses. So that allows us, when we look at the loss maker, to identify how much of its losses, be it current period or be they brought forward losses, would now be eligible for surrender within the 75% group, the effective 75% group. We also know that when you surrender that loss to the claimant company, the profit-making company, that as it says here, the relief is taken against the TTP of the same period as the surrendering company's loss-making period. Where we have different accounting periods, it would be unusual, but the point is made just here, and we'll be looking at it next time, is it is possible that we'll have companies in the same group, but for whatever reason, one of them or more has a different accounting period to others. It's unlikely in real life, but it's quite likely in an exam question, at least in an objective testing question anyway. And we'll be looking at that separately. So it must be relief taken against the TTP, taxable total profit, not total profits, taxable total profit. Remember what that is, total profits less those qualifying charitable donations paid, of the same period as the surrendering company's loss-making period. But we have to look at now those profits of the claimant company in just a little bit more detail. So for this, let's just go back to another note that we prepared for you here, because although that claimant company clearly on its corporate tax computation has a taxable total profit for this period, if it didn't have taxable total profits, it ain't a claimant company because there's nothing to claim against. It has a TTP this period. But what it may also have is its own losses. So claimant company, we set off against the TTP after having used, after the use of, its own brought forward losses. So when you work out, having already established the amount of loss available to be surrendered by the loss-making company, we then target the TTP of the claimant company. That TTP of the claimant company will firstly be reduced by that claimant company's, that profit-making company's own brought forward losses. Yeah, it may be that it is, of course, a profit-making company now, but previously it may have been a loss maker and it's got its own brought forward losses. They will presumably and probably be trading, but they could be trading and or property business losses that we're talking about. So the brought forward losses take priority within the claimant company before you bring in any other group members' loss in a current period group relief claim. So if we looked at this situation, therefore, if this is the claimant company, you can see it's a profit maker. It's got total profits there of 320,000. Then any brought forward losses would target there the total profits of this particular period. If, for the sake of argument, those brought forward losses were £120,000, then that would leave £200,000 of revised total profit. Assuming there were no qualifying charitable donations of this period paid by this company, then to deduct from this revised figure of total profits, then that would also be your taxable total profit. So what it means in this profit making, this claimant company for purposes of group relief this period, the maximum amount of loss that could be brought in from another group member this period to be group relieved is not what would have been £320,000. It is that less its own brought forward losses, and that therefore means the maximum would be 200,000. The claimant company's own brought forward losses take priority here prior to bringing in any group relief. That's what that note there says. In the claimant company, set off the surrendering company's loss in a group relief claim against TTP, but after the use of its own brought forward losses. Hopefully that makes sense. This one, however, might not make such sense to you at first sight. We are talking about the claimant company, i.e. the profit-making company. And we are now saying that before we use any group relief claims this period against the claimant company's profits, we firstly use the company's own current period losses. Hang on a minute. What I'm now telling you is that the claimant company, the profit-making company, is itself also a loss-making company. So you're thinking, hang on a minute, that can't be right. How can the profit-making company, the claimant company, also itself be a loss maker? Well, it can, obviously, otherwise we wouldn't have this particular rule. So let's just go back and have a little look at that example that I set up for you here. Now let's just clear the decks in terms of... Oh, no, sorry, that's not the... If we have, going the wrong way, in the claimant company, there we go. Let's get rid of that. And we'll get rid of those. And what we're going to do now is to say, well, there we go. There's what's happened this period. But all I've got to do is change one thing. And that trading income becomes a trading loss. Now, it still means it's a profit-making company. Because on its CT computation, what will it show? It won't show a bracketed £100,000 trading loss. It will show nil. It has, therefore, property income, 220. So this company is a profit maker because its TTP, assuming there's no donations paid in the period, its total profits and its TTP are 220,000. So its corporation tax computation is showing it as a profit maker, a TTP 220. But it is also a loss maker there. It has that trading loss of £100,000. So the note that we've just seen says, when we bring in to this claimant company, this profit-making company, it's got a TTP of 220,000. When we bring in the loss from the surrendering company in the form of a group relief claim, that can only be after any deemed use of its own current period losses. Now, whether you choose to make that loss relief claim doesn't matter. So here, what are we going to have as the maximum group relief claim? It's TTP of 220. For purposes of a group relief claim, must firstly be reduced by that £100,000 loss. So now, the maximum possible group relief is going to be not the 220 TTP that it had, that figure there, but minus the potential current period claim, whether you claim it or not, of 100, and that therefore would be £120,000. That'll be 120. So this is one that always poses problems for students when we start telling them that the profit-making company, the claimant company, the one receiving the group relief from the surrendering company, is itself this period a loss maker. Yes, it is perfectly possible for this to be so. As you've seen here, it's got a trading loss of £100,000, but it still has a TTP. Here it's got a huge amount of property income, £220,000, constituting that total profit. It could have been interest income. It could have been a huge, great chargeable gain that arose. So it's perfectly possible for a company with maybe a very significant profit, and therefore an obvious contender within the group, to be a claimant company for another company's loss in a group relief claim, that still itself could be a loss maker. Obviously, that loss will be a lot smaller than the overall amount of profits that it actually has. Seems odd, but it's perfectly possible for that to happen. Going back to our notes, therefore, the important points now to remember as regards group relief are: losses can be group relieved against 100% of a 75% subsidiary's TTP, or conversely, 100% of a 75% subs loss can be group relieved. As soon as you have the magic share ownership level of 75% or more, that means the companies in question, parent company owns 75% of subsidiary. That means that group relief is available. And it means, therefore, that if the subsidiary made a loss and the parent company made a profit, even though that percentage interest is only 75%, all of that loss made by the subsidiary company is available for group relief to the parent company. And the other way around, if the parent company made a loss and the subsidiary made a profit, as long as that percentage shareholding permits group relief to apply, then 75%, 80, 90, whatever, share ownership gives access to 100% of those losses. Don't go and think, well, we only own 75% of the subsidiary, therefore only 75% of its losses can be used. No. As long as you've got the minimum 75% shareholding, then for group relief purposes, there is access to all of that company's losses. As we said, the relief is not restricted to the percentage shareholding. Any amount of current year trade and business property losses can be group relieved. Well, any amount of current year trade and, be careful there, excess property business losses can be group relieved. We've also said that amounts of brought forward unused trading and business property losses that cannot be set off in surrendering company may also be group relieved. The surrendering company has brought forward losses, but it can only surrender those losses that it was not able to use within its own company's corporate tax computation. So it's got to use its own brought forward losses against its own current period profits before any access to surrendering the balance of that loss to other group companies would be permitted. And again, we've looked at then within the claimant company what amount of profit would be eligible to absorb the surrendering company's own brought forward losses that are now being group relieved. Again, go back and check through that. These are the tricky things that we may have to deal with. It's quite possible that again, exam questions could be very straightforward in the context of who can group relieve with whom and the amount of loss and the amount of profit that are able to be set off. But it is equally possible that some of these more awkward situations may arise. Most awkward there would be the brought forward losses that we're talking in terms of now being eligible for group relief this period. We also said that where we've got accounting periods of two group companies that are different, unlikely in real life, but more likely in an exam question, then group relief will be restricted to the corresponding or coterminous period. It is therefore necessary to time apportion both the loss-making and the profit-making periods to work out how much loss can go against how much profit in each accounting period. That's not for now. That's the object of our next lecture, mostly of the next lecture there, when we look at those non-coterminous accounting periods. And all it is time apportioning. Time apportioning what amount of loss against a time apportioned amount of profit for a corresponding period, because they have non-coterminous accounting periods. The loss maker might have prepared accounts to the 31st of December. The profit maker may have prepared accounts to the 31st of March. So any loss-making period spans two profit-making periods. How many months of each of those two profit periods, and we time apportion accordingly. It's not difficult, but it's messy. But that's for next time. One final point here, in terms of the notes. In our particular syllabus, only UK resident companies are eligible for group relief, though two UK resident subs of an overseas resident parent would be able to group relieve with one another, though neither could group relieve with its overseas parent company. So if you had P Inc. incorporated overseas, a non-UK resident company, and then you had, not H, we had S1 Limited, UK resident, S2 Limited, UK resident, and the percentage share ownerships was at least 75. They may well be wholly owned, but as long as the overseas, the non-UK resident company, has 75% plus shareholding in the UK resident companies, then these two companies, if one made a loss and obviously the other made a profit, S1 and S2 could group relief. But no group relief would be possible with P Inc. itself. Even though they're in the same 75% group, no group relief there would be possible. That would also extend to one final point now. Remember the old AV group of companies? We had that AV group of companies there, and we'd identified who was able to group relieve with whom. Again, if we clear up what we have there, we had the relationships that existed between each of these companies. Well, if AV owned, now I'll say 100%, it could be 75%, right? But we'll say 100%. If they owned 100% of Real Villa, or Real Villa, Inc., then no group relief, though they're in clearly at 100%, they're in the same 75% group as AV. That is true. But you wouldn't be able to group relieve. If Real Villa Inc. made a loss, you couldn't use that loss within the UK taxation system there. No group relief would be possible. But if we then had Real Villa Inc. owning a UK resident company, let's call it Lions Limited here. Now, here, because that is 100%, this has to be at least 75%. I say that because 100% of 75% will make it effective 75%. So what it means is AV, principal parent company, through a non-UK resident here wholly owned subsidiary company, Real Villa Inc., has an effective 75% interest shareholding in a UK resident company. So if Lions Limited were to make a loss, then that loss could and would be, if we choose to make the claim, group relieved against any of AV Group's group companies for purposes of group relief. AV was in a group with F, C, and Clarets. So now if Lions made this loss, that loss, though it couldn't go to Real Villa, its non-UK resident parent company, it could go in part, in full, against any part of the TTP figures of AV, of Company F, Company C, and Claret. It is UK resident. The other AV group members are UK resident. They can group relieve. The fact that the link from Lions back to the principal parent AV, whose group it is, the fact that that link is via a non-UK resident company doesn't matter. There is effective 75% holding from the parent company, principal parent company, down to this indirect subsidiary, which is itself UK resident. The link is via non-UK resident, but it doesn't matter. Again, the companies about to group relieve are in the same group, and they are all UK resident companies. It's just that none of them would be able to group relieve with the non-UK resident company itself. Right. You have, therefore, a lot to be thinking about before next time. That's going to mean that you're going to have to go back through this and break it down into bit by bit, go back through the examples I've just talked you through quite quickly there. But at least you can do that on a recording. So go back and make sure that you've got this knowledge piece by piece. There is then this example 3. Now, the only thing that I've had to do is just put a little note to you here. For some reason, I've got a different accounting period end date, so apologies for that. Back in example 2, we got introduced there to Z plc and its very strange group structure. That it went Z, sub-subsidiary, and then a further sub-subsidiary there. And we worked out who could group relieve with whom. In that example 2, for some reason, the accounting year-end date was the 30th of June 2021. I want you here to assume Z plc prepared accounts to 31st of March 21, not the year ended June 21 as shown in example 2. The reason being is because here we now suppose that B Limited had commenced trading on the 1st of October 20, but prepared accounts for the 6-month period to the 31st of March 21. It's a different date. So can you assume, therefore, that both Z and B and all the other companies there, they have got a 31st of March accounting period end date? And just see what would happen. Now discuss the group relief available in respect of the Z plc trading loss for the year ended March 21 if it were to consider surrendering the trading loss to B Limited. The point about B Limited being here that it only came into existence on the 1st of October 20. And that will introduce you to the idea of corresponding periods. To be able to group relieve, we have to be matching like with like. If we've only got 6 months worth of crossover of corresponding period between the loss maker and the profit maker, then only 6 months of loss can go against 6 months worth of profit. But have a go at that. I'll talk you through it next time. But don't rush on now to that next lecture. I need you to go back and look at the important and tricky issues that we've covered over this extended session.